Celsius just acquired Alani for $1.8 billion, and in this video you're going to learn the details of the acquisition. And if you're in the business of buying other businesses in the M&A world, I'll give you 3 of the biggest strategic lessons you can use for your next acquisition. Alright everybody, so if you guys have not heard, Celsius has actually acquired Alani New for 1.8 billion. And for those of you who are curious on, if this is your first time here, obviously it is because this is my first video, but this video is going to be pretty much an M&A analysis, not so much of an in-depth one, but just my thoughts on who won the deal. Is this worth the deal? Are there synergies within the deal? And what we can learn from the energy drink world, whether you're an investor, whether you're looking to start an energy drink company. Yeah, this is all really good news. And the reason why I make these videos is because I really like to look at M&A deals, and this is something I already do, so I might as well just record myself thinking out loud. All right, so 1.8 billion. So what is Alani, and what is Celsius? So Celsius is just a energy drink brand that started around 20 years ago in the early 2000s. Alani is a recently new company that was started by an influencer. Alani founder, started by this female named Katie Hearn. She was a fitness influencer who started in 2016, and she started an energy drink company called Alani. Alani. Let's go to their website. So if you guys don't know what Alani is, nutrition. Alani is an energy drink company that's specifically targeted toward females. As you can tell by this, if you're watching this on YouTube, as you can tell by their website, they look very, very feminine. So previously, before the whole energy drink craze, right now energy drink companies were predominantly hyper masculine, right? Think of the sorts of Red Bull, Monster would sponsor pretty much every single UFC event because that's their target demographic is men, right? You have Bang Energy. Well, Bang is actually a little bit newer, so I wouldn't put them in the same category, but we have Rockstar, we have a C4 for those who used to drink the C4 pre-workout. Most of the energy drinks were in fact hyper masculine. So what they did differently is they made an energy drink specifically for females. And what I think a lot of people don't realize is that females actually, in the retail world, females actually spend significantly more in consumer dollars than males, which is why would you target males if females spend most money? I don't know, but anyways, someone figured it out. So Celsius Holdings, blah blah blah. So Celsius is public for those who don't know. They acquired Alani. So new stands for nutrition, right? So they acquired Alani for 1.8 billion. And as we look here on Yahoo Finance, the acquisition of the energy brand Alani represents a revenue of less than 3x for 2024, right? So 3x. So if we just back of the napkin math, 1.8 million divided by 3 equals 600. So they were doing roughly 600 million in revenue, which is pretty good. The transaction would be financed through a combination of 1.275 billion in cash and 500 million in stock, along with the potential $25 million earnout. So there is some performance tied to the acquisition, but it's very, very insignificant. $25 million on a $1.8 billion acquisition is very, very small. Blah, blah, like I was talking about, female. It will bolster the appeal to female customers, blah, 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 blah. And they actually have a 50-50 demographic split, which does surprise me. It does surprise me because, this kind of energy drink I would have guessed that they, have 70 or 80% female consumers. Blah, 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 blah. So what I really actually want to go into more deeper is actually the Celsius Holdings website, and I wanted to actually talk about why. So pretty much this breaking news says Celsius Holdings acquires Alani, creating a better for you functional lifestyle program. So this is pretty much in code a justification to their investors on why Celsius strategically bought Alani. All right, so net purchase of 1.65 billion, representing an attractive valuation of less than 3 times 2024 annual net revenue and approximately 12 times fully synergized. Who knows what the hell that means? Fully synergized. How do you even calculate fully synergized 2024 annual EBITDA? This is crazy. It's crazy. Why synergized 2024 annual EBITDA? Who knows what that means? Transaction expected to be accretive to cash earnings per share in the first full year of ownership. Celsius today separately released fourth quarter and full blah 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 blah. Oh, it's actually raining outside. So this is the part that kind of confused me a little bit, where it says Celsius Holdings Inc. today announced that it has entered into a definitive agreement to acquire Alani Nutrition for 1.8 billion, including 150 million in tax assets. What the heck does tax assets even mean? I don't know. If you guys know what 150 million in tax assets, if you guys know what that means, please let me know. For a net purchase price of 1.65 billion, compromising a mix of cash and stock. All right, blah 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 blah. This is more jargon. Blah 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 blah. So Max Clemens, co-founder and co-CEO of Congo Brands. So Congo Brands, for those who don't know, right? So this girl, Katie Hearn, she was an influencer who sold predominantly fitness products. I'm not really gonna undermine what she did, because I'm sure she had some sort of contribution to the success of this brand. However, what people don't know, especially in consumer facing brands, all they see is like, oh, look at, the Katie Hearn starting XYZ brand, or you have The Rock starting Terramount, or you have Conor McGregor starting Proper 12, right? For most consumers, they think that these influencers are actually doing all the back end work, which is not true, right? They're not true. The game that is being played, what a lot of people don't know, the game that is being played is these influencers just serve as a launch pad, right? So a launch pad and / brand awareness / association, right? So Proper 12, for example, Irish, Conor McGregor is Irish, right? So the 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 operating people who started Proper 12 seen an opportunity where Conor McGregor is Irish. What are some attributes that Conor McGregor displays in his personal brand? Hard work. Well, when he first, when he was on his run, um, winning style, you know, um, et cetera, et cetera, et cetera. And there are a lot of people who there was a lot of people who looked up to him. But here's the big but: is Conor McGregor actually the one going out and making these retail partnerships? Is he the one doing the cost control? Is he the one having quarterly meetings? Is he the one raising capital to scale distribution? Right? No, he's not. Well, a lot of people don't realize, and I'm sure if you're watching this, you understand this, right? But for those who think more on the consumer side, all they think, oh, Conor McGregor started his own brand, and he's doing all this stuff. There's a lot that goes into the game besides the forward-facing influencers, right? So where does that tie back to? Alani New is Congo brands. So sure, Katie Hearn is the forward-facing face of the brand, yes, but the company that is behind it is Congo Brands, and a lot of people have not heard of Congo Brands, but they also own. They are like the operators, the back end operators of some big brands like Alani New, Prime, and Lunchley. And previously, they were the back end operators of 3D Energy with Christian Guzman, but they had a whole feud. They had a whole feud, and they parted ways and stuff like that. But Congo Brands, they're pretty much back end operators of these big brands, and then they partner with a big influencers to launch the product, and then they go ahead and handle the distribution and all the back end operations of each brand. Like Prime is actually, I think they're actually executing well, in my opinion. I know they get a lot of flack. They do get a lot of flack. However, a lot they're scaling. So Prime is actually the two forward facing influencers of Prime is Logan Paul and KSI. But I think Congo Brands is actually doing a good job of scaling that brand significantly past the initial audiences of KSI and Logan Paul. So they do the kind of back end scaling. We see here at KSI. These are two. If you guys don't know who they are two very big YouTubers that have millions, like 10, 20, 30, 40, 50 million followers combined. And yeah, so this is the operating company behind. So let's kind of look at the numbers. Let's look at the numbers on Alanu. Here's they call it the compelling strategic rationale. So why did Celsius acquire Alanu, right? Was it just to pump up revenue? Was it because Celsius, they couldn't, they had a hard time growing revenue organically within just the Celsius brand, right? Were they looking to target another segment of the market? Why did they spend 1.8 billion on acquiring another brand when they could just theoretically pump all that into growing Celsius. So the reason why Celsius purchased Alani is, one, it creates a leading, better for you functional platform at the intersection of consumer megatrends. With the addition of Alani, the combined Celsius platform. So, okay, platform. So when I'm not too sure how they're using the word platform, but in the private equity world, right? If Celsius is using it in a strategic sense, like private equity uses platform companies. So how a platform company works is, one big platform company is the big company in that niche, right? So an example, it's going to be the biggest company in a bigger holding company of smaller companies. What the heck does that even mean? So I'll explain to you the platform strategy in a very, very simple example. Let's just say a platform company is a big plumbing company, right? So you have the holding company, let's just say the mother, and then you have its first child is the biggest company of that holding company. And now that you have a platform company, now you can acquire add-on companies in order for you to, replicate the systems, processes, branding, marketing, sales systems of the platform company. So Celsius already has its systems and processes in place. They have the branding, they have the marketing, they have the sales, they have the retail distribution, right? Those are the biggest pillars when it comes to consumer products, is literally the marketing and then the retail distribution, because you can only scale so much with straight e-commerce, right? You look at any big consumer facing, CPG brand, and retail. What a lot of people don't tell you is retail is how you really get big. So anyways, hopefully you learned something new with that. So Alani is actually going to be an add-on company to the platform company of Celsius, which is very smart because they have all the infrastructure in place, and specifically the retail distribution. All right, second reason is it combines two growing scaled energy brands with clear category tailwinds. The transition is expected to enhance Celsius's position as an innovative leader in the large growing global energy category, which is projected at a 10% CAGR. CAGR is compound annual growth rate from 2024 to 2029 with a scaled on-trend sugar-free platform. Blah blah blah. I actually thought the energy drink category is actually would have a bigger CAGR. 10% CAGR is pretty standard in most industries. So I want to say standard in every industry, but in more fast-growing industries. So they're saying that reason number 2 that they acquired Alani is because they believe that this category has a tailwinds that will help them grow. They're pretty much saying that they're betting on this category. All right, reason number 3 is they provide complementary brand positioning and attract their consumer demographics and is expected to drive incremental category growth. Alani will provide Celsius expanded to access to a fast-growing, wellness-focused audience that is driving incremental category growth. So what they're pretty much saying is that now that they acquired Alani, now they have access to a totally different demographic. They have access to a totally different demographic than Celsius, which is pretty much the female demographic. All right. Reason number 4 is they leverage combined strengths and capabilities to drive the next phase of growth. The added breadth of the combined platform is expected to further strengthen the company's position with ample resources and ongoing investment. Both brands will be well positioned under the Celsius platform to drive continued distribution gains, access consumers, and growth and growing adjacencies, drive innovation and brand awareness, achieve incremental category growth, and further propel further global expansion. So what they're saying here, reason number 4, is that they're saying that this is kind of the growth lever that Celsius decided to pull. So they decided that it's a better strategic decision for them to grow through an acquisition on growing Celsius rather than just growing Celsius more organically through sales and marketing. So on that accord, they believe that they're almost maxed out on what they believe they can grow Celsius to, right? So instead of just growing Celsius, they're growing this other brand. They feel like they can grow the more revenue by acquiring instead of just growing. All right, and the last reason that they acquired Alani is because it enhances top line growth algorithm, and it's expected to be cash EPS accretive in year 1 with a meaningful synergy opportunity. The acquisition of Alani is expected to add significant top-line scale and growth, and is expected to be accretive to cash EPS in the first full year of ownership. $50 million of run rate cost synergies are expected to be achieved over 2 years post-close, contributing to strong pro forma profitability and significant cash flow generation. So what they're saying here is, and this is probably their biggest reason, is they're just saying that acquiring this company is going to provide us a lot of revenue growth. That's it. Like, that's, in more fancy corporate jargon. All right, so here are the details of the deal. This is what I actually like to look at. We're pocket watching on the highest level. Under the terms of the agreement, Celsius has agreed to acquire Alani Nu from its co-founders Katie and Hayden Schneider, and Congo Brands co-founder Max Clemens and Trey Steiger for $1.8 million, comprising much of cash and stock and potential $25 million based on 2025 performance. Here's the meat. This includes approximately $150 million net present value of tax benefits for a net purchase price of $1.65 billion, and represents an attractive valuation of less than 3x 2024 annual revenue of $595 billion. So what we talked about earlier was right. So in 2024, they did approximately $600 million and approximately 12x fully synergized 2024 annual EBITDA of 137. Wow, 137 million in EBITDA. That's pretty damn good. But who knows? The thing, my biggest question is, who knows how they account for quote unquote fully synergized 2024 what the heck does fully synergized 2024 annual EBITDA means? Who the heck knows? More details on the transaction. The purchase price consideration is comprised of $1.275 billion of cash and a $25 million earnout, and $500 million, or approximately 22.5 of stock, representing approximately 8.7 pro forma ownership. The cash consideration consists of fully committed debt Oh wow. Oh, this is big. This is big. The cash consideration consists of fully committed debt financing of 900 million. Ah, this is the details that matters, right? Debt financing of $900 million and approximately $375 million of cash. So they're leveraging I don't want to swear on this channel. The crab from this deal. They're getting $900 million of debt. Wow, and they're only spending $375 million of cash. The company, and then the rest in stock. The company's liquidity position is expected to remain robust at a pro forma net leverage of approximately 1.0 to the fifth power and ample cash on the balance sheet. Stock consideration will be subject to a lockup agreement, which is released over a 2-year period, aligning long-term interests to drive future growth and value creation. Blah, 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 blah. The agreement has been approved by the Celsius Board of Directors. All right. So, blah, blah, blah. These are just more details regarding the numbers. Oh, this is pretty interesting. So, net income. So, year ended 2024 Celsius. Celsius has a net income of $145 million in net income, and Alani has a net income of 68 million. Non-GAAP EBITDA of 163 million for Celsius, and 80 million for Alani, and 243 million total pro forma. Non-GAAP adjusted EBITDA 255, 86, blah blah blah. That's pro forma net synergy. So they're estimating that if these brands work together and use a lot of cost synergies, use a lot of the same resources for both brands, they're gonna save $50 million in net synergies. Wow. All right, so what is the bottom line? So the bottom line here is adjusted pro forma adjusted EBITDA. So what the fuck does, so pro forma is simply an estimated. So anytime, especially this happens a lot in real estate, and it's kind of irritating, where they tell you that the pro forma net income. So pro forma is pretty much as if everything goes perfectly planned, which it barely does. But pro forma is just an estimated adjusted EBITDA. So pro forma adjusted EBITDA, EBITDA is earning before interest, taxes, depreciation, and amortization. It's a fancy word for profits. Not exactly the same as net profit, but it's an accounting term that identifies something close to profit. Not exactly the same, but it's profit, right? This is what Celsius is estimating that this deal will be able to generate. So they're expecting Celsius to generate 305 in adjusted EBITDA, 305 million in adjusted EBITDA, 86 million in adjusted EBITDA for Alani, and 392 million for both, for the holdco on top. All right, so, and let's actually look at the stock price. So here in Yahoo Finance, their stock actually dropped quite a bit right? So at their peak, they were actually around 95-ish dollars. So that's a big drop. And this is just last year in 2024, which is not quite, but almost 3x. Almost 3x the value of what they are now. And I think I seen, yeah, when I last looked at them last year, they're around $18 billion market cap, and now they're 8.4 million, sorry, billion, billion in market cap as of today, and today is April 1st. So watch out for the April Fools, you guys. Let's kind of take a look and a breakdown of their financials really quick. I got 15 minutes before I gotta go. So in 2024, they did 1. Wait, actually, I do want to see their PE ratio, which is, oh, that's a high ass PE ratio. Wow. Okay, so the market is paying 79.4 PE ratio. So PE ratio is their price to earning ratio. You just divide the market cap divided by the earnings. And wow, that's actually a pretty good deal, because if they paid 12x to Alani Nu, 12x quote unquote synergized EBITDA, and they're trading at 79x the earnings, that's actually a pretty good deal, right? It is actually a pretty good deal for Celsius, especially because their stock is trading at a very, very high PE ratio. So 2024, let's see how this company did. And this is the first time I'm looking at this, so we're looking at this real time. 1.355 billion in revenue in 2024. Expenses of 1.19 billion in expenses. Jesus Lord. So an EBITDA of 163 million. Wow. That's a crap ton of expenses. And an EBITDA of 163. So when we go back to so Celsius is making 163, and they just bought 80 million of EBITDA. Now that we kind of learn the information about the acquisition that just happened, now we're going to give you $1.8 billion worth of strategic lessons that we can learn from Celsius and why they purchased Alani Nu. All right, so the first strategic lesson is number 1, brand synergy and market expansion. So Celsius and Alani Nu have overlapping yet distinct audiences. Celsius dominates the fitness-focused energy drink market. So think people going to the gym, going to what's it called, CrossFit, maybe even boxing or MMA, or etc., etc., etc. While Alani Nu has a strong female-driven wellness branding in supplements and beverages. Right, so Alani Nu, their demographic is more so female-driven wellness, right? So this is a big strategic shift that Gary LaVecchia from Bloom actually made. So he's a genius. He's a genius in this, because when they started, here's some insight that a lot of $100 million plus brands, these are the conversations that 9-figure, 10-figure brands are having, right? They're not so much of, oh, let me press this button on Facebook ads, right? It's not that. So when Bloom started, their first customer was the fitness female enthusiast, right? His wife was the face of the brand, and they targeted, their first product was actually a pre-workout, I believe. And where they figured out, they kind of, they realized that the TAM is total addressable market of pre-workout, of females who work out, is much more small than the quote unquote female driven wellness market, right? Now when they made the Bloom, the greens, now that product is catered to not just females that work out, but females who are into wellness, right? It's a big $100+ million shift that they made, because if they just stayed in supplements, they would only be able to target females who work out, which is a very niche audience, right? If you go to the gym, then you'll think that it's a big audience, but when you look at the data and you look at the research and you look at the market trends, females who work out, the audience is really not that big, right? So Celsius again is more so fitness focused, and Alani Nu is more so general wellness, right? And it's a big shift. So now that Celsius has acquired Alani Nu, now they have access to that female driven wellness branding category, right? It's same product, but it's a totally different demographic, right? So the next point is this acquisition allows Celsius to tap into a new demographic, what we were talking about, while leveraging Alani Nu's distribution in major retail chains like Walmart and GNC. So what that means is that they, like I was talking about the demographic, but now they can just, when we say tap into a demographic, what does that even mean? So in this case, it means that we have access to that demographic and we can sell them stuff at Target, Walmart, and GNC, right? Celsius already has retail distribution, so getting another brand from the same holdco is gonna be very easy compared to if Alani Nu was just an independent brand trying to get into these retail partnerships. All right, so the lesson here, and here's the lesson that you can implement in your own M&A strategy, or even if you're building a business. Well, not so much if you're building a business, but this is more so M&A strategy. So this is going to be more advanced stuff. So the lesson here is acquisitions should complement, not cannibalize, an existing brand. This is huge, guys. This is huge. So if I'll finish reading the lesson before I riff on this. So expanding into new customer segments through established brands is often smarter than launching a new product from scratch. So what we mean here, and it's nuanced, it's very nuanced, but it's a big difference, right? If Celsius and Alani Nu were targeting the same demographic, it would make no sense to make this acquisition. Imagine if Celsius, they're focused on fitness, focused energy drink market, blah blah blah. But if Alani Nu also had that target demographic, they would be targeting the same demographic, which would make zero sense, right? So one of the biggest reasons to make an acquisition, and here's what you can use personally for your acquisition, is if you have company 1, make sure company 2 has a totally different audience, right? Make sure the company that you're acquiring has a totally different audience, because it would make no effing sense if your target demographic of the company that you're acquiring is the same as the company you already own. It would make no sense. So when you're how you can implement this in your acquisition strategy, because I don't want to just talk about news, right? Here's a side riff, which I feel like is very important. I don't want to just be a newscaster. I want to show you how these insights from these billion-dollar companies and lessons that they're spending billions of dollars testing these theories, and I want to, you know, distill it so you can use it in your own acquisition strategy. Anyways, so again, if you ever come back here, just know that this is not a news channel, right? This is a actionable, distilled, strategic channel where you can use strategic insights that you can use on your own acquisition journey. Anyways, lesson number 2 is retail and distribution power play. Alani Nu has secured premium shelf space in major retailers, something that takes years to build. By acquiring Alani Nu, Celsius immediately strengthens its retail presence, increasing its ability to negotiate terms and with distributors and retailers. So, what that means here, when you're playing the retail game, terms, you know, net 30, 60, 90, etc. When you're playing the retail game, terms are very, very important. If you're a $100+ million brand, or in terms of Alani Nu, they did $60 million in revenue, I believe. Right, 60 was it 60 million? No. Sorry, way off. $600 million in revenue. Right, $600 million in revenue in 2024 fiscal year. If that if they don't have terms with the retailers, they have to, especially in retail-based businesses, they have to purchase hundreds of millions of dollars worth of inventory before they are able to sell that inventory, right? And for a lot of independent brands, they're not going to have that 100, 200, 300, 400 million dollars worth of working capital that can be tied up for, you know, net 30, 60, 90. They're not going to have enough working capital to sustain that until it comes back from the retailers, right? So what I'm saying here is a big part of the retail game, if you're going to play that game, is getting terms, right? If you're able to get good terms, if you're, let me take a step back here. If you're able to establish strong relationships, right, with retailers, for example, let's take things to the extreme here. Coca-Cola and Walmart. Coca-Cola and Walmart have a strong relationship. So when Coca-Cola sells to Walmart, Walmart has no doubt that Coca-Cola will sell, right? But if you come in with a new brand, let's just say Mike's, there's actually Mike's Hard Lemonade, but let's just say Mike's Apple Juice, right? Whatever, a new brand. The retailer has no idea if your product is gonna sell. So anytime there's unsold inventory in any retail environment, that's like detrimental to a retail business, especially, you know, they're operating on very, very thin margins, 1, 2, 3, 4, 5% margins. So every little product that they have in store needs to sell, right? So I'm going on a tangent here. So the lesson here, lesson 2, is acquiring a company with strong retail distribution can provide an instant competitive advantage and accelerate market share growth. Remember here, guys, anytime you're making an acquisition, it's not always just financial. All right. So in the M&A world, there's this thing called acqui-hires. Acqui-hires is when you buy a company not for the IP or the company or for the revenue or for the EBITDA, but acqui-hire is when you acquire a company just because you want to acquire the talent that that company has, right? In this case, this I wouldn't say is a big advantage, oh shit, for Celsius, because from what I know and from what I understand, they already have pretty strong relationships with retail partners. But this would make sense in a case that, let's just say, Celsius has strong relationship, or if Celsius wasn't in retail yet and they acquired Alani Nu, and Alani Nu had retail relationships, and Celsius wanted to get into retail, right? If that makes sense. It does make sense. If it doesn't make sense, just rewind a little bit back. So the lesson here, and in context, the lesson here, especially if you're in a retail game, let's just say you had XYZ protein powder and you wanted to get into retail. One potential strategy you could actually use is to acquire a company that already has retail distribution, and then leverage that relationship to get other brands and products that you own into those retail retail places, right? So and in even broader terms, lesson 2 is that acquisitions aren't always financial, especially when you're playing this bigger game. There's many different strategic reasons for acquisitions. When you're playing on the smaller game, the 1 to 10 million, of course, majority of it is, multiples, 1 to 5 million, and 1 to, I would even say 5 million, even 10 million in revenue, in annual revenue. The reason for purchase is usually just EBITDA, right? But when you're making 50, 100, 100 million, a billion, these different types of acquisitions, a lot of the time it's not financial. Many of the times when bigger companies make big acquisitions, 9 figures plus, it's for strategic reasons. So a bigger and even bonus lesson for lesson 2 is to understand that there's more than one reason for acquisition, and it's not just financial. All right, so strategic lesson 3 that we learned from Celsius is, this word's a mouthful, premiumization and higher margins, right? While Celsius plays in the mass market energy drink category, Alani Nu has higher margin products, including supplements and functional beverages. The acquisition allows Celsius to diversify its revenue stream beyond just energy drinks, leveraging Alani Nu's premium branding and strong D2C model. So what this means, it's more of a diversification of revenue streams, right? So if you look at Celsius and you look at Alani Nu, majority of their revenue is made from the mass market energy drink category, right? And how they're diversifying their revenue stream is because Alani Nu has supplements and other higher ticket items that are not just $2 to $5 per pop. They have supplements that cost, not too sure how much they cost, but in the realm of $30 to $60. So these higher margin plays are actually huge, especially when you're playing the retail game, because when you're playing the retail game, the margins are very, very tight, right? Very, 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 like every little cent literally counts. But when they have higher margin products like supplements or pre-workout, or I really don't know, because I'm not a shopper. I don't shop at Alani Nu, But once they have these higher margin products, they could even use that to offset the lower margin cost, the lower margin products that they have that they sell in retail centers. So they could even use it as a branding play. So they could even use all the energy drinks, kind of like a top of funnel play, and then they can drive all those people who buy the energy drinks to buy the more expensive supplements and stuff. So here, the lesson here is a well-placed acquisition can increase margins and help a brand move upmarket, reducing reliance on a single product category. So how do you implement this in your own acquisition? This is a matter of there's a lot of nuance to this, but imagine that there's kind of three categories. We have the lowest price, right? In any given category, we have the lowest price, the middle price, and then we have the premium price, right? So think in automobiles or cars, we have on the lowest, we have maybe Honda slash Toyota slash Nissan. And in the middle, we have maybe Mercedes, BMW, BMW, and maybe even Tesla, maybe, except the Model 3. And then in the premium price, we have exotics, Lamborghini, Bugatti, Ferrari, etc., etc., etc. Right? So how you can use this is to go up market or down market, depending. This strategy will depend on where your product or service is priced. So if your product, let's just say, let's just stick with the automotive example. So if you owned a mid-priced product like BMW, don't buy another mid-priced competitor like Mercedes, right? Or Infinity, or or any other mid-market positioned products. You want to buy upstream or downstream. So if you own a product or service that's mid-priced, maybe you want to go up market, right? Maybe you want to buy a premium priced competitor, right? Like Ferrari or Lamborghini, because now you have access to a totally different demographic. So what Celsius did in this instance is that Alani Nu is actually upmarket, right? So I wouldn't say Alani Nu is premium price. I wouldn't really say that. I would say Celsius is kind of on the lower mass market energy drink, so it's on the lower price category. And Alani Nu, I would say, is like more of the mid ticket industry, mid ticket category in the energy drink market, right? So the lesson here, again, distilled in 10 seconds, is buy if your company that you own today is mid market, go upstream and acquire a company that has premium offerings, because that will often have higher margins than the lower or mid ticket categories in that market. All right, so these are the three biggest strategic lessons that you can use in your acquisition. It's three strategies that Celsius used that you can use in your own acquisitions. All right, so what I want to know in the comments, number one is, so right after you're watching this, go ahead and comment down below. I want to know, number one, who do you think won this acquisition, right? Do you think Celsius won, or do you think that Alani Nu won? And the second thing I want to know, and why do you think they won? Whose position would you rather be in? Would you rather be the seller in this position, or would you rather be the buyer? And my second question is, if you're in the business of buying other businesses, which of these three strategies are you going to use for your next possible acquisition? Alright, go ahead and comment down below, and I'll see you guys in the next video.